Well, welcome everybody. Man, I tell you, a Wednesday night talking about taxes, I know everybody's excited, right? Well, thank you for coming tonight. And again, I think what brings all of you out is essentially this, little bit of tax change we had that got rushed through at the end of last year. But it's the largest tax reform, the largest tax change that's happened in 30 years. So pretty significant. It definitely changes the rules quite a bit. So I appreciate everybody coming out tonight and hopefully learning some of the high level. The big overview and kind of explanation as we walk through things tonight is this is the law. This is what's been passed. The way that it's going to be implemented is yet to be determined, right? So there's a lot of things, a lot of questions, a lot of things that are pending and kind of waiting on guidance, are waiting on how the tax court or the IRS will come out and enforce it. And so a lot of these things are fairly new and drastic changes, and they open up a lot of opportunities for good planning. But the key is don't just take something that you see and apply, because a lot of that guidance, a lot of those rules have yet to come out and are still question marks amongst us and other good planners that are looking at this tax code. So first and foremost, thank you and welcome. Again, my name is Tom Winfesti. I'm an attorney and CPA with NC Planning. A little bit about NC Planning, and then we also have some team members here that I'd like to have them introduce. NC Planning is a law firm that focuses truly on proactive relationship, open communication, legal planning. And so our goal is to really look at elements like this, make sure we're addressing that with clients on an ongoing basis versus a reactive basis, right? Which is kind of the typical model for law firms and otherwise. But really what we focus on is estate planning, estate administration, right? Which Kyle's going to talk about the estate tax changes tonight as well. And then we do a significant amount of corporate and business planning for clients. So just by a show of hands, business owners in the room? Okay. Another show of hands. How many people in here prepare their own taxes? Okay, good. About a half and half on both. So that works out well. What we're going to try to do now is just do a quick intro. I think our NC planning crew is in the back of the room mostly. If you guys want to just do a quick intro, and we'll start with Paul.
But my name is Kyle Frizzell. There it goes. My name is Kyle Frizzell. I'm also an attorney with NC Planning, and I focus on personal planning and business planning, kind of split my time as well. So,
thank you, and I think everybody met Meredith outside, and again, happy to have you here. What we're going to jump into is on December 20th, 2017, this Tax Cuts and Jobs Act was passed. You'll see it out in the news as the Jobs Act. You'll see it as the TCJA. But essentially what it was is there was a lot of debate, a lot of politics in play, but it was the largest tax reform that we've seen. It was about 500 pages of new changes to the tax code. And essentially the big question a lot of people ask is, why was it done? And really why it was done, first and foremost, was, of course, politics, right? So it was what was campaigned on by the president, by certain congressmen, House Republicans, otherwise. But the biggest thing, the motivation on everything was corporate tax rates, right? So not to say that it didn't impact individuals, but that was the largest motivation. And just to give a little bit on history, we're talking about, for the most part, C corporations or larger, corporations out there. The tax rate in 2017 for these corporations was 35%, right? Internationally, you were dealing with countries that over the years had continually dropped their tax rate, right? Ireland, for instance, is at 12%. So what you had is you had the U.S. sitting there at a very high tax rate for corporations, and over the last few decades, really, the big companies were moving everything overseas, including the cash, because it was more economical for them to do that, to invest, to take the headquarters there, to keep cash ashore or offshore. If they brought it on, they'd have to pay tax, right? So a lot of them started to invest in foreign jurisdictions, and that was a big concern. So essentially, the motivation and the drive was to drop that 35% tax rate, which we'll talk about, which they substantially did, and really try to encourage those companies, which a lot of them are U.S.-based companies, but to bring that money back to reinvest in the U.S., right? Domestic investment is a key theme throughout these changes, and it started with that corporate tax rate. The other that was kind of pitched and sold was for everybody, right? We're going to simplify your tax return. It's become too complicated. And so the goal was, I think it was a postcard it was supposed to be. So it may not be a postcard, but for some or for a lot more, it will actually be a lot easier to file your tax return. One of the things that they talk about is the groups that may have lost out the most are like the H&R blocks, some of those where a lot of individuals would go to, because now your taxes or that group that have a simpler tax platform has become a lot simpler to file. And we'll talk about that as we go forward. But again, it was to bring that investment over, to simplify, and then of course you had to throw in there the aspect of, what about all the other business owners, right? What about those small, mid-sized business owners? And what we're talking about here is business owners that would classify themselves as sole proprietorships, S-corps, LLCs, partnerships. All of those kind of got thrown into the mix of, we got to help them as well. The key theme, again, was we've got to help out domestic production. We've got to get more money in business pockets, individuals' pockets, and hopefully they'll invest it back in the U.S. economy, right? So that's kind of the driver behind it. It's definitely a political but also economic driver. So let's talk a little bit about what we're trying to cover tonight. We will go through individual taxation changes. We'll hit on estate and gift taxation. Again, substantial changes in all of these areas. Business, we'll go through that C Corp, the big business changes, what that could potentially mean. We'll also go through the, what I'd say the small, mid-sized, normal businesses that we see in S Corps and LLCs. Talk about who the big winners are, who the losers are, and then essentially, what does it all really mean to you, right? And kind of what carry forward items, happen. But the big thing is, if you look at an individual, there is a handout that everybody should have that can kind of compare what did the past law look like on your structure, and what's the new framework look like when you're going to go file your taxes, a year from now, right? Because everything goes into effect essentially for 2018, so we're not talking about the taxes you're getting ready to file. We're talking about the ones you'll prep potentially in a year plus. But also there's potential strategies to consider on that to make sure that you're gaining the benefits of the individual taxation. The estate and gift, substantial changes. It didn't get repealed. That was one of the big things that we heard over and over again, was the estate tax was going to go away. It did get a significant increase in the exemption, which Kyle will talk about, but it is still in place, and there are still concerns because of those two areas and somewhat on the business taxation. They did it to us again by saying, hey, we made all these great changes, but guess what? They expire. 2025, right? So a lot of these things, you can plan on until you can't plan on them, right? Now, Congress can screw things up, next election and change everything of what we have. But a lot of that was put to not create too big of a deficit in the budget and everything else. But the corporate rates that we'll talk about, the C Corp, the big business, those are permanent. They have no expiration. The others, the individual, the estate tax, just know that they do expire. And so at some point, it's going to become a big campaign measure for everybody to look at and carry forward. So again, business taxation, we'll also hit on those C Corps. We'll talk about the deductions that were lost and some that were gained. There is a big thing, again, upon the simplification of your tax return. A lot of things that were itemized deductions have been changed. They've been kind of lessened, so you can't itemize as much as you used to. They're trying to force you to use this new standard deduction that I'll talk about. So let's talk about individual taxation. if everybody wants to look at that chart and kind of in the handout of the old law versus the new law, the biggest thing is essentially the rates have changed substantially for some. And there's less brackets. There was 9 before, and there's 7 now. So, the question is this a good thing or is it a bad thing, right? I think if you took a glimpse at it or if you heard the rates have dropped, everybody's going to say, oh, it's a good thing, right? But it also collapsed so we have less brackets. So some people actually may have moved up in taxes, right? Depending on where you fall on your, taxable and adjusted gross income, you may actually have a change in your tax rate up versus down. But most of the rates all dropped. So now the tax code, regs, you have, 10%, 12%, 22, 24, 32, 35, and a max rate of 37. Used to be a max rate of 39, right? But now they've dropped it. That's big dollars depending on where you fall in that, right? Just on the applicable percentage tax rate that applies. And again, that's once you get to your taxable amount, this is the rate that you multiply it by to say this is the potential tax liability. So if you went from a 2% drop, that could be real dollars to you as it applies through. Again, it depends on whether it's good for you or it's not, because of the aspect of it depends on where you fall in those rates. An example of this, if a married filing jointly taxpayer with taxable income of $200,000, right? 2017, you were a 28% rate, right? So if you were at 28%, your tax rate would be $56K, right? Or your tax potentially on that 28 would be 56. In 2018, you've dropped down to a 24%, right? So now you're talking about a $48,000, potential tax. And again, this is before anything else. But just on rate alone, that's a 3K savings, right? A 8K savings. If you talk about, though, however, you're married filing jointly with taxable income of $410,000, again, you're earning more. That's a good thing, right? But then on the flip side, if you look at your 2017 rate, it was 33%. 2018, it was 35, right? So it actually went up, but it's because when they collapsed those brackets from 9 to 7, you fell into the upper one just on an increase. Questions on individual, just the rates overall? Yeah.
So is that a scale or is that whole thing, let's say you're 410, the whole thing goes to that bracket, or is it, between,
You have to get down to your taxable income, right? Which is going to be after deductions, other things. So it's kind of a calculation before that rate alone applies, right? And I'll talk about that in just a second. But essentially, it's not, if you get your W-2 statement or anything else, it's not that number that throws you into that rate. It's once you've taken some deductions from that. Is that your question?
I think he's asking your rates are calculated based on the first 5,000 is some rate and the next 10,000 is another rate.
Correct. So if you fall into that, right, yes. Right. Does that answer it?
So is it the same as what it was before? Like the first, how many thousand would be taxed at, and then
Right.
the excess will be taxed at that rate that you now fall in?
Correct. So again, when you look at that, as far as the graduated rates and everything else, it comes down, though, after you've calculated that taxable income, and you can apply to it, that standard. Long-term capital gains and qualified dividends. The only reason to mention this is there actually wasn't a change, but there was a lot of talk about potentially changing these rates, right? And just as a review, again, you were either at a 15% or a 20% capital gains rate and dividends rate. And when we're talking about capital gains, you're talking about, long-term investments, whether you've held them for over a year, whether that's stock, real estate, potentially the sale of a business. But when you go through that, again, depending on where you are in income, you're either at 15% or 20%. Those stayed the same, right? We also still, if you are at that top margin of 20%, you still have that 3.8% investment tax, which was also kind of referred to as an Obamacare tax, but that still applies. So long-term capital gains, qualified dividends actually stayed right where they were, right? But there was talks about changing those rates and everything else, but essentially they stayed where they were, which, depending on what you're in or anything else, is a good thing. When we look at the S-Corp and other taxation, boy, it would be nice if they would have dropped some of the capital gains tax as well. Standard deduction versus itemized. So just as an overview, again, of how your 1040, your individual tax return works. So if you take everything you made, right, whether it was from business income, W-2 wages from your employer, anything else, that's where you start, right? And then you go through what they call the above-the-line deductions, right, which are some things like retirement, self-funded retirement account, other items that can kind of drop you down to your adjusted gross income, right? Once you get to that level, typically what people decide is, do I take a standard deduction, which is just this number that the IRS gives you as a deduction, which determines, do I owe a tax, right? If I subtract X from Y, if tax already paid, will I owe a tax? Or do I go over here and do all these itemized deductions, mortgage interest, charitable deductions, all these other things, and that's where a lot of the complexity came from, right? Because you have to keep more records then, right? You have to go through, but for a lot of people, itemized deductions would benefit you more. You'd outpace your individual standard deduction, from that standpoint. So again, we go through that. Once you get past the standard deduction or the itemized, you'd also look at personal exemptions that you would get. And these are for dependents, right? So when you look at personal exemptions, if you got a dependent, you got one for yourself, one for your spouse, one for kids, right? And that was about $4,000 or so, last year. And so you would get to add those up as well, right? And so all along what the goal is you're dropping that amount to figure out, do I actually owe any tax, right? Or do I get money back? Hey, good thing, right? But from that aspect is you get down to that final, which is your taxable income, right? You look at any, apply your applicable tax rate, and then you look at any credits, tax credits you may receive to kind of, zero out, that item. So I know that's an explanation, again, for how many that don't prep their taxes, but from that it's kind of a hierarchy of how it builds. It depends on our deductions above the line, which are those key items before you get to adjusted gross income. Are they below the line? And then credits come in at the last bit, right? Well, the big change was on the standard deduction side. You had a change in kind of to go from essentially, if you look at that, the old law was $6,350 for a single individual, $12,700 for married, and now we're dealing with basically double that. So you got 12 for a single and 24 if you're married, right? So what does that mean? Again, if we're working through that hierarchy, what that means is essentially a lot of people that used to jump over and go to itemized and have to go through, all of that with mortgage interest, everything else, now they don't have to go that far, right? So that was the solution, I should say, that they've proposed to make your taxes simpler, right? If you have less than $24,000, right, then now you don't need to do that. And they doubled it, right? So it should make your tax return easier depending on your situation or otherwise. However, what they did is, even though they doubled that, those dependent exemptions I talked about, those are gone, right? So those are gone, and those are gone, and essentially from that standpoint is, what they did do though is they said, hey, for the kids, we're going to take that child tax care credit, again, you get that at the end, and we're going to double it. So you don't get your exemptions anymore. We gave you more in standard deduction, but we are going to give you more at a credit on the end, right? So now it's a question of, did I just win or did I lose, right? And you don't know. But we can take a look at it, right? So let's take our first example. Married, no kids. You had before $12,700 standard deduction, plus you each got a personal exemption, $8,200. So you got about $20,900 under the old law as kind of a deduction. The new law, you get 24. That's your standard deduction, right? So you won, right? That's a good win, for you if you're in that potential situation. Married, 2 kids, $24K again under the new law. That's your standard deduction versus $29,100 under the old law because you had the standard deduction plus for exemptions, right? However, you do get this increased child tax credit, right, from 1 to 2 that comes at the bottom. So the question is, well, did I just win or did I not, right? It looks like I might have won more under the old law, but it just depends on how you finalize and determine your tax liability and then apply that credit to it, right? So it's kind of a question mark at this point that will be individualized based on each person's return. Married 6 kids and you make $200,000, right? 24 under the old law, you would have gotten $37,600 because you had so many kids, right? However, you do get $12K of the child tax credit to offset any liability. Married with 6 kids, but you make $410,000. Well, you better make $410,000 because you got 6 kids, right? The problem is the child tax care credit phases out, right? So at $400,000, it fully phases out and you lose it, right? So if you've married, you make that much money, you have that many kids, you really just lost under that scenario, right? But again, you better be making that money because you need that for the cost of kids. Questions on that? I know that's kind of a jumbled explanation on how things work, but the biggest thing is you got a doubled standard deduction. They took away your exemptions and sold it as, we just made your taxes easier, right? Maybe they did. For a lot of people, they probably did. They estimate that there's probably going to be about 15% of those that did itemize before. If there was like 30% that itemized, of that 30%, they think about 15% will drop off and go to standard deduction. We'll see, right? We'll see if they're right or anything else, but that's part of the simplification. It won't be a postcard, but essentially it may make your tax return a lot easier if you fall under that standard deduction and just using the child tax care credit. So the question is, who is going to need to itemize? I mean, essentially what we talked about is, if you are over that standard deduction and you can still go through things to kind of benefit more than the $24,000, you're definitely going to want to still itemize because it's going to help you more on those taxes. It's interesting though. Remember, we talked about above the line deductions and then we talked about the below the line deductions, and that's where all the itemized deductions come into play. Well, different itemized deductions were payment of taxes to North Carolina, your home state, right? Property taxes, income taxes, otherwise you could deduct on the federal return. Charitable deductions are on that itemized piece. Casualty losses. So if you invested in a Ponzi scheme, lost all your money, right? You could deduct that. If you had a building burned down and you didn't have it fully insured, right? A flood, you didn't get your full recovery back. Those type of things. Mortgage interest, right, which we heard a lot about in the media, right? But mortgage interest was on there. The mortgage interest you pay is an itemized deduction, right? So that's part of that. Unreimbursed employee expenses, right? So things that you didn't get paid or reimbursed for. Tax prep fees. So I said, essentially, CPAs lost in a couple different ways, which I'll talk about in a minute. But the H&R blocks, the others, which are, rely heavily on saying, hey, but you can deduct our fees, right? Well, you can't anymore, right? So that's a big change otherwise. So other material changes on the individual side, right? Again, think about where we're going. They're trying to make it easier. They're trying to force you to use this standard deduction. So what else did they do? They changed a lot of these itemized deductions, right? They made them less attractive to use. Mortgage interest, right? Mortgage interest deduction now, you can only deduct up to a $750,000 mortgage, right? Anything over that you pay in interest is non-deductible, right? So if you have a $1 million loan, you only get to deduct $750,000 times the interest rate that you pay, right? That was a big push, and again, a big worry. You got to think the banks and the mortgage companies lost in the lobbying battle on that one because, again, it dropped what was a huge incentive, which is, hey, I get to deduct mortgage interest. So if I have 2 homes, right, then I can deduct mortgage interest on 2 homes, right? But that's changed. So if you have 2 homes and it's over that cap, now, good fiscal habits, I know we've got some financial advisors in the room and otherwise, don't have too much debt, right? So it's a significant change, and you'll see that in other changes in this code as well, is they're really trying to force some savings and otherwise to carry through. No mortgage interest deductions on home equity lines at all, right? So anybody used a home equity line for improvement on their house or anything else? used to be a great tool to go out and get a very low interest rate. You go out and buy a car, you can invest in your business, you could do all these great things and deduct it, right, on your tax return. It was usually a lower rate, and you got the deduction. No more. So it'll be really interesting. Yes?
I thought that was still being debated on the usage of the money.
Gone. Right. Yep, there was kind of looking for the guidance or anything else, but no. So,
Even if that money is used for a real estate purchase and then you're showing that as an expense for the income from it.
so it's your primary residence. If it's a home equity, you're talking about it's not. If it's in your business, totally different. We're just talking about individual, like primary or a secondary home, right?
Meaning, I'm taking the home equity from my primary residence, I'm investing in an investment property.
Right.
That is okay.
They'd say no. Now, question is kind of how I opened up. We'll see how the facts come out, right? Because you could then say, well, this was a business expenditure, right? And always the opportunities of, well, I mean, I'm kind of loaning my business or myself the money, right, through this. So it'll depend on how it's reported. But actually, the code says no more on home equity. Yep.
Question about CPA, you said tax prep fees.
Yep.
Is there a fine line between tax prep and CPA advice?
I mean, they've just eliminated any tax prep fees. Again, as a business owner, right, you could always deduct that. But I think on the individual side, that's going to be gone.
Businesses were fine.
Businesses, you're fine. We're just talking individuals, right? A lot of this,
Sorry, it doesn't matter when the equity line is taken out.
they're just not going to allow it anymore in 2018. So if you have anything carried forward in 2017, but in 2018 going forward, they're just not going to allow it. And again, it'll be interesting because a lot of people are sitting out there saying, you know, give us more guidance on this. It's really interesting, before you get into too much politics of how it was rushed through, you may have heard in the media, but it was something that basically the House had to vote on it twice because they actually, you know, how it got passed, they passed things that shouldn't. They almost left out, you know, something that they totally didn't intend to leave out. And so it was this big rush to get it done and a lot of little missteps along the way, right, from that change and challenge and everything else. So from that side, you know, a lot of changes, but home equity lines, gone, right? And that's, I think, a big thing because a lot of people did use them. So we'll see how the banks, mortgage companies, everything else react to that. State and local income tax, sales tax, property tax. Anybody here that you should rush and pay your property taxes before the end of the year, right? I think I heard the line, you know, with Department of Revenue, Wake County was around the corner, right? People were rushing not only to pay their 17 taxes, which had been assessed but not yet due till January for property and whatnot, but people were trying to pay 18, right? Because the new law says we're capping your deduction at $10,000, right? Which means if you pay your property tax, your income tax, sales and use tax, anything you pay to North Carolina, you can now only deduct up to $10,000 on your federal return, right? So if you have, you know, again, only individuals, so not business investments or otherwise, but if you have, you know, a mountain place, a beach place, and your primary residence, you know, and property taxes alone, it'll push you over, right? If you pay, you know, $3,000 on your property tax here, plus you pay, you know, $8,000 in income tax to North Carolina, now you can only deduct $10,000, not $11,000, right? So this was the big thing that said, you know, New York, California, right? High income tax, high property tax places, tough, right? You know, that was the Fed's basically, or Congress's, you know, take on that is, we don't care that you charge this, we're not going to give a full deduction or offset. So people rush to do that. The big guidance that came out is 2018 probably will not be allowed. So if you prepaid 2018, not 2017, but any unassessed ones probably won't be allowed as a deduction.
So in North Carolina, the state income tax is at least $575.
Mm-hmm.
And that's all,
Yeah.
just so I can do the math in my head. Let's pretend for a second it's 6%.
Mm-hmm.
Make 200,000. You were able to deduct that 12,000 plus your property tax.
Yep.
Just that first 10,000. So you're not deducting that too, or any of your property taxes or any other taxes.
Yeah, it's all lumped in. So they're going to lump everything you pay to North Carolina and cap it at 10, right? One of the key strategies we'll talk about is, can you take individual stuff, right, and move it to business stuff, right? Because if there's an opportunity to do that, this does not apply to businesses. So just, you know, for example, if you have a beach house, right, that you use just as your residence, you really don't rent it out, maybe you rent it out a couple weeks a year, anything else, and that property tax would push you over and you wouldn't be able to deduct it. But you throw that beach house in an LLC and treat it as somewhat a rental property, now you can deduct it.
Just real quick question on the, let's go back to this individual's example here, this gentleman right here, that let's say it was $12,000 state income tax that you had to pay, then you got a $2,000 refund because they overestimated.
Right?
In the past, you would have gotten a tax notice and you got to put that in your tax return.
Right.
Would they be able to differentiate that you've already paid the 10, that 2,000 is back return principal?
We'll see. I don't know. Again, we'll kind of see how it all plays out, everything else. But from that standpoint yeah, we'll see how it's all done. And the states are scrambling now to see how they're going to deal with this, which was basically just something that kind of was dropped on them from that standpoint without any kind of, advance notice. Other, quick material changes that may impact, there's lots of other things, but, from that standpoint is casualty losses, which again are like, I was burglarized, fire, water. If you had a loss, right, on that, you used to be able to deduct that or offset that against income on your tax return. Now they say only if it's a federally declared disaster. Hurricane, tornadoes, right, those different things. But if it's just personal to you, no more offset on casualty losses, which is a pretty significant change, especially when you look at a lot of things that you've paid taxes on that you may not get back. Charitable contributions, there was a change that allows now a deduction up to 60% of your adjusted gross income. So it went from 50 to 60. So it actually allows you to deduct or give a little bit more and offset against your income. However, I don't know if we have any sports fans in here, but they no longer allow any deduction if you bought NC State, Carolina lifetime rights, or your tickets or anything else, right? You used to be able to get a deduction for that. I know, right? Right. If there's any Iron Dukes in the room, that, pay the big fees. But that used to actually get a partial deduction for that as a deduction to charity. No longer will they allow that. Charitable deductions, though, will become a big play because it has a direct benefit to impact taxable income. And taxable income is a big theme, especially as we get into the business taxation and otherwise. So there's a lot of questions about, hey, if you're going to move to a standard deduction, what's this going to do to charities? And kind of, will people still give to charities? Probably most will, right? Just based on a charitable, inclination already. And the big donors, of course, will because they'll be over the, 24,000 standard anyway.
So can you just use business to give to charity?
Well, you can use a business to give to a charity and anything else, and you'll deduct that as a marketing or other business expense. But essentially, you can still do it as an individual up to 60% of AGI. So they haven't changed that deductibility. What the fear was is if people are getting now a larger standard deduction, would they even move to say, hey, I should give $1,000 to charity, right? And that's a question. I don't think that'll be a significant change based on, I think people just give to give for the most part. Yes?
Can I just go back to the topic about the property tax?
Sure.
So if you paid advance 2018 property tax, it's not going to be deductible in 2017?
Correct. That's kind of what at least the guidance has come out. We'll see. A lot of people may put it on their return, and then it's just a question of whether they flag it or not. But they basically came out and said since it wasn't assessed yet, right, you couldn't do it. Now, it's always funny because everybody's like, hey, Department of Revenue took my money. Wake County took my money. Of course they want it. I mean, they're happy to take your money. Yeah.
Your auto property taxes fall into the 10,000 tax?
For auto property, yeah. Anything you pay to the state. Yeah. Registration fees would potentially be, different or otherwise, but yes. Property tax you own in other states? Right. It'd be, that's a good question. I don't know how they'll apply that based on, because I think they're going to give you, I don't know if they're going to give you a state by state, right? Or if it's just going to be 10,000 cap across the board. I don't know. But I can look that up and see how they apply, or we can wait on further guidance. The last significant change, and it kind of goes into investment, if anybody uses 529 accounts, right, for investment or otherwise, the change on 529s, they kept them, they're a pre-tax, you can put money in, and allow it to grow tax deferred for college savings. So parents use it for kids, right? Put money in, every month it saves up. Grandparents can kind of super fund it, so they may put a whole bunch of money into it. Well, they changed it to allow, now you can use it for private school. Pretty good, right? So if you got a kid, attending private school or whatnot, up to $10,000 a year can be used on that. Other quick questions? Otherwise, I'm going to move forward because we're definitely moving a little slow behind time. So we'll move over to the estate tax. Not North Carolina. Other states, depending on it, but North Carolina used to be and they don't anymore. So I'm going to turn it over to Kyle. He's going to talk to you about estate and gift.
All right. Thanks, Tom. I'll try to use that thing. I may stay back here just in case this thing wants to go off on me again. Well, again, my name is Kyle Frizzell, and I'm going to talk to you guys a little bit about estate and gift tax this evening. And of course, that raises the question, what is estate and gift tax? Well, essentially, both of these taxes are transfer taxes. The difference is when you pay them. Basically, you pay an estate tax when assets are being transferred over an exempted amount to someone else at your death. The gift tax is the same thing, but you've made that transfer during your life. And if you've looked ahead in your handout there and you see there's something called generation skipping tax on there, definitely not going to go into that too much, but I did want to mention that it's also a transfer tax, works basically the same way. The difference is the generation skipping tax is when you're passing assets to someone more than one generation behind you. In your family, that's typically grandchildren or something further down the line, or individuals who are a certain number of years younger than you when it's outside of your family. That's a separate exemption. The estate and gift tax exemption are tied together. So one of the things that we wanted to cover here was what happened to the repeal. So if you go back to way before tax reform was being pushed through at the end of the year, the estate tax exemption was slated to bump up slightly to $5.6 million per individual. But when tax reform really started to heat up, the original proposal in the House bill, I think the last time we saw it was in November, was going to double the estate tax exemption to $11.2 million and then repeal it starting in 2024. Then eventually what happened though is everything becomes political and the estate tax became a bargaining chip and the repeal of the estate tax was removed from the Senate bill and what was eventually passed into law. So where are we now? And that's where your handout comes in. The estate and gift tax unified exemption last year was $5.49 million, meaning that you could pass at death $5.49 million to someone estate tax free. That's been doubled to $11.2 million per individual, meaning that potentially a married couple can pass up to $22.4 million estate tax free, estate and gift tax free because those exemptions are combined. We also included on there the annual gift tax exclusion has been bumped up $1,000 to $15,000 per individual or per person per individual, meaning that a married couple can pass to another individual up to $30,000 gift tax free every year. We did throw the generation skipping tax on there as well. That mirrors the estate and gift tax unified exemption. It's a separate exemption. It doesn't count against the estate and gift tax. Those are different. So we wanted to look at an example of what this means. Let's see if we can do this. So say that you passed away, or an individual passed away in 2017. They made no lifetime gifts, and they had a net estate of $6 million. That $6 million net estate was reduced by your exemption. Again, they made no lifetime gifts, so there's been nothing taxed against that amount. That left you with a $510,000 taxable estate. Rough math on that puts you at $204,000 estate tax liability. Looking at those same facts, but in 2018, and in this case, negative numbers are a good thing because it means no tax. That $6 million net estate has that 11.2 estate tax exemption. There's actually a potential carryover if you're married for that estate tax exemption. That's what I'm hinting at there with the effects of portability. Again, that 11.2, say you don't use it as, an individual doesn't use it and it passes to their spouse if you've elected portability. Again, the result of that is that $22.4 million can pass estate tax free for married individuals. We're going to look at an example in a few minutes of what lifetime gifting can do, but that estate tax, or playing with that with the estate tax, you can potentially pass much more than $22.4 million. So, there we go. What does that mean for new planning opportunities? Well, the kind of joke up there is you could die before 2026 and leave more in your estate. The fact is that after that, it's going to revert back to the $5 million base that's indexed for inflation. No telling what that might be in 2020, I guess 2026, but somewhere in the $6 million range, maybe. So again, you can you can begin or continue annual gifting, and we'll look at a simple example of that in just a moment. And then trust and generational planning. Essentially, that's the same kind of planning that you would do now. It's just making use of the larger exemptions, and essentially to protect you, the plans would have to account for any reversion in estate tax rates. So an example of what that annual gifting I was talking about can do is, say that an individual is married, they have a net estate of $25 million. I didn't want to put life expectancy, but let's say they're on a 15-year gift strategy. They got 2 children, 4 grandchildren, just to throw some numbers out there. With no gifting, there's a potential tax liability of a little over $1 million. Say that you start this annual gifting strategy, a married couple can make the $15,000 gift per person times 6 children, which potentially gets $90,000 per spouse. That passes estate and gift tax free. That means that each of the individuals can pass $180,000 a year gift tax free, or over $2.7 million in excluded gifts. My example's cut off up here. I don't know if it is there. But anyway, what it's showing is that that $2 million estate tax liability from before, in the example where there's no gifting, can cancel out the annual or the estate tax liability after that. And so what are the concerns here? Again, one of the primary concerns is the uncertainty that's surrounding the future of the estate tax. I mean, taxes are never certain, but we don't know what's going to happen, whether here in 5 years they're going to make the exemption $11.2 million per individual permanent. And again, another concern is that those with plans specifically referencing old exemption amounts or just old plans in general, they really need to be looked at. If you're worried about estate and gift tax liability, they need to make sure that they're going to make use of these $11.2 or $22.4 million. So what can you do right now? And that's really just sitting down with your team, your attorneys, your financial advisors, and making sure that everything is going to flow the way you want it to and keep money out of the IRS's hands. So that's really all I have. If there's any questions about that. And if not, I'll turn it back over to you. Got one? Yep.
Your planning on that, this is the example where you had $25 million
Yep.
in there, and even at a 5% return, you're going to have $1 million. If you give $200,000 away, you're essentially adding $1 million to your estate all at the time. So you're going to have to do more advanced planning. My question
Right.
is, if you do more advanced planning, what's the likelihood that when the law reverts and maybe 10 years, whatever it is,
Right.
that you're going to go back and those plans are not going to work? I mean, if you gifted a lot to family members and use your gifting
Yeah.
strategy.
Right. I mean, it's a risk, right? I don't know. Do you have any guidance there either? It would just have to be something that has to be reevaluated if it's going to revert. You want to account for it.
Yeah, the worst part of the whole structure is they gave us another deadline, right? This 2026. Again, Congress can change it at any time if they can get together to do it. But when there's a deadline and it's set to expire and then revert back, that's the fear. Because it's like, oh man, if Congress can't get their act together, they're really going to screw us up, right? Anything that really we would do from a planning cycle right now is take advantage of the gifting, right? You've got these years to look at if you don't need the money, right? If it's high wealth individuals or whatnot, make sure it makes sense from a basis standpoint and everything else, retirement standpoint. But go ahead and take advantage of this. Start moving the money to the next generation. That way, if Congress does screw it up, you're good, because you've already moved it, right? You've moved it under the current framework and law versus waiting to see, hey, I died in, January of 2026, and they just happen to not get their act together and continue this, right? So we played this game, back in, 2012, right? Everything else, kind of as things were increasing and then waiting for them to do it. And, everybody's sitting back saying, what are they going to do? How do you plan? Also, as Kyle mentioned, a lot of the old plans are based on saying, hey, the max amount of estate tax. Well, the max amount of estate tax just doubled, right? So if you had a trust that maybe had some tax planning in there, now's the time to really review that language just to make sure that you didn't just move all of your assets somewhere that you didn't really intend it to be, right? Because the estate tax exclusion has increased so much, right? So it should catch less people. I mean, they just gave you, double the amounts, especially if you're married. Now you got a lot more. It should catch less, but it also opened up a great opportunity to look at moving money to the next generation, how to do it efficiently, and don't let Congress screw you up in 2026.
Any other questions on estate and gift tax? All right, well, I'll turn it back over to you.
Now we get to the fun stuff. And no offense to, individual taxation, right? But there's less creativity, there's less opportunities sometimes. And again, on the business side, to business owners that are in here or others, that are even employees, do contract work for businesses, there is significant changes that were put in place here that are just new. They're totally new things, and we'll talk about that as we go through. Again, I already kind of mentioned the leading change was that C corporation, tax change. So we had this rate drop from 35 to 21%. So if you want to think of some big companies and think about they just went from paying 35% on every dollar they earned to 21%, that's huge, right? Anybody hear about Walmart getting everybody raises? Anybody hear about Apple paying $38 billion in taxes, right? And how they're going to reinvest in the U.S. economy? That's where all this is coming from. Plus the fact that if they bring the money back over and they reinvest it into the U.S., they only pay 8% over 5 years. So they can actually finance it with the IRS, right, on the taxes. So if Apple brings all this cash they have sitting overseas and bring it back over, right, and that's what I joked about. If you take $38 billion, right, multiply it probably by 8, which is probably what they're paying on it, right? That's really the total amount of cash that they're going to bring over, right? Walmart said, hey, tax cuts. We can give people raises. We can increase benefits, right? Because they've seen a significant drop, right, and savings to their bottom line. So the big businesses, which are typically the C Corps, right, they've won. Well, as shareholders, as owners of that stock and otherwise, you should win as well, right? Profits should be up. Dividends should be paid, right? So we'll see, right? Everything is we'll see. This was a political, change to impact economic, driving force domestically, not internationally, but domestically. So that's the big change on the C Corp. We will see if it plays out. But again, significant changes. Apple, all these other companies have said, we're bringing money back over. We'll see if they do and how much, but it's definitely a better platform at 21%, compared to what we were. We were like the highest internationally, right? So we're still not as low as Ireland, right? But we're definitely offer more domestically than Ireland can as far as infrastructure, workforce, domestic production. Questions on big business at all? Yes?
Well, Apple brought that money back.
Mm-hmm. Or bringing it back, right? Yeah.
Bring it back. But it had a negative effect on their earnings. Why wasn't it?
A negative effect on their earnings? Because I don't know for sure, but again, they're going to have to show somehow, right, bringing all that money back over and paying a whole bunch of tax at once, right? I mean, $38 billion, right? So that's going to drop their earnings, but should project forward to increase it, right? Because hopefully they'll be under that lower rate. I mean, they're doing it for a longer-term play than just the immediate. But again, same thing. I mean, everybody, if you're bringing cash over, there's an immediate tax hit there, which is why they even gave more incentives to say, no, it's not 21% if you bring it over here. It's going to be, I think it was 15%, right, percent. But if you reinvest it in the U.S. economy, it's 8%, right? So if you bring the cash and you reinvest it, we'll give you a great deal, right? Because before, if it even came close to touching anything with the U.S., it was taxed at the high rate, right? So companies would specifically set up foreign headquarters, right? Never have this cash, everything was siloed to make sure it never came over, because the U.S. was the heaviest and said, if it even touches anything, we tax it. And then we'll give you an offset maybe on treaties that we have with foreign jurisdictions if you pay it there, but it's not a dollar for dollar. So they've really tried to come at least more competitive on that side. The individuals still have some of those hits, and estates will still have some of those, but C Corps, you got a pretty good deal. Great question there. Others on the big business? Let's jump into the pass-through entities. Again, sole proprietorships. That could be a consulting independent contractor, one-person shop. S Corps, right? Construction companies, real estate firms, CPAs, lawyers, most of them are all S Corps, right? LLCs, partnerships, depending on how everything's taxed, but any of those pass-through entities, and why they call them pass-through is you pay one level of tax, right? You earn dollars and they just kind of all flow through onto your individual return, right, in one way or another. So those pass-through entities, this significant change was this creation of qualified business income. Deduction, right? So a qualified business income deduction. And just so I don't get it wrong, qualified business income is normal operating income, right? Excluding capital gains, dividends, interest. So if you had some investments that your business held or otherwise, and you got some interest, or you had sold some property, you got some gains on it, whatnot, that's not included in your income. It also excludes compensation payments made to you, the owner, and it excludes any guaranteed payments, which comes under partnership taxation, which is still kind of like compensation to the owner. So basically what that says is normal operating income that you make through your business, excluding wages that you pay yourself. Wages, right? Not your profits, but your wages. And so as an easy example, right, on this, if we just say, let's say a business owner pays themselves, makes $200,000 in their business, and they pay themselves $100,000 in wages, right? So $200,000 total income, right? They pay themselves $100,000. That leaves us with $100,000 of QBI, qualified business income. It's a 20% deduction. They just got a $20K deduction. Not a bad deal, right? Do the math. What if it wasn't $100,000? What if it was $500,000? What if it was $1 million? This is the biggest change to, I'd say, small, mid-sized business owners, is this QBI, qualified business income deduction, is truly significant, right? What's that? Rental income, QBI. It is, right? And for landlords, real estate investors, I'll talk to you about it in a sec, you won big. So, from that standpoint, though, that's the most significant, right? Any business owners who got tired of paying self-employment tax, on wages, everything else, you still have to do that, right? You still have to go through and do that, but this is what they gave you. They gave you a 20% QBI deduction. Huh. A cap, right? Sure there's a cap, right? And sure there's other limitations to qualify for it, right? So the biggest thing I would tell you is that if, right, you are a business owner and your individual taxable income, right, so on your 1040, look to line 43 on your 1040, if that is under 157 single or 315 married, so you're talking about your taxable income on your 1040. If you are under those numbers, right, you get the full amount of the deduction, right? Whatever 20% of your QBI is, you get, if you're under that. If you go over that, then the fun begins, right? So if you go over that, there's 3 different things we have to worry about, essentially, right? And these are kind of the limitations. The first limitation is the one I'm most upset about, right? But if you are a specific service business and your taxable income as an owner, right, is over that 157 or that 315 taxable income, and you are in the healthcare field, doctors, dentists, oral surgeons, right, those type of individuals, If you're in law, I can't believe it. Accounting, CPAs, right? Consulting, athletes, financial and investment advisors, brokers, right? Anything which they've said is where the principal asset of such business is the trade or skill of one or more of its employees or owners. So they hit the professions, right? So if you're in a profession where you're known and your business is that, right, then essentially you have a different set of rules, right? So I look at that and say, what the heck are we paying all those dues for to the Bar Association? They really didn't lobby worth anything, right? The CPAs on the AICPA lost out. But who won? The engineers and the architects must have the best lobbyists because they were excluded from this, right? Engineers and architects are not included in that. And so they actually don't have the limitation that I'm going to talk about, which is the QBI deduction phases out once you go over that 157,315. So if you go over that on taxable income, right, your 20% deduction starts fading away. And once you get to essentially 207 single and 415 married, it's gone. So taxable income becomes very, very important to control because that 20% deduction, right, you want to qualify for it if you are in any of those categories. So if you're a consultant, a broker, anything that's about you, right, you want to be very cognizant of your taxable income throughout the year. Look at every way to control that taxable income so that you can get the 20% deduction and you don't just get there and say, CPA, are you kidding me? That's how much I made? Well, don't worry. I got a 20% deduction coming to me, right? And they say, sorry, right? So you definitely need to control that. Yep.
So do you get that 20% up to that max amount?
Well, no, you just lose it. Yeah, you made too much money. Sorry. You're out. So if lose it, gone. Manage your taxable income, right? And there's key ways to do that, right?
Is this deduction increased from last year or is it still the same?
Totally new. They just created this, right? They call this, we talked about the above the line deductions. We talked about the below the line, the itemized. They call this one the in between the line, right? Because it was never there before, and they don't know where to put it because it's kind of the business owner aspect and everything else. So it's going to be, I mean, these are things, IRS doesn't even have the forms yet, right? They don't have to worry about that till next year. Yeah, Dave.
Correct me if I'm wrong, but today, your flow-through income is part of your taxable income.
It does hit your taxable income, correct?
So when do they apply the 20%? Does the flow-through comes to over 157?
Let me see the calculations. Haven't even seen them yet, right? The IRS hasn't even released any guidance on it, right? Based on how that'll flow through. It's interesting on this one because there's interpretations that people have taken that says owner wages are actually intended, they meant them to be included, right? Even though the law, when you read it, says no. And so that's where I said, even though there's this rule out here, and this is how we're interpreting it now, guidance on how it'll actually be calculated hasn't even been released yet, right? Because the IRS always is in a rush to get forms out, even for this tax year. They're talking about getting you, your CPAs and your accountants and everything else forms so that they can prep for this year, which means your 2017 taxes. So they really haven't even got to the point of 2018 guidance fully yet. But they're working on it, right? And we'll start to see some of that guidance, and then we'll start to see some of the abuses that'll come with it as well. Yes, Neil.
These deductions, talking about you're calling business deductions,
Right?
but they flow through the personal expiration. Because the personal stuff expires at some point in time while these changes. These do not expire.
They will expire.
These will expire.
Mhm.
Okay.
Yep. Anything really that, the C Corp's the only thing that really stayed in place, right? They said big business, that's permanent, right? The rest of everything, because the whole reason behind it is there's huge losses that they're projecting in revenue, right? At least initially in tax revenue. And so to kind of cap where that would be, they said, oh, but we'll stop in 2025 and everything will, shift a little bit more. So they didn't want to see the losses as much.
So they do see this as an expiration. Who knows what then?
Yep. And so this qualified business income deduction, if you are a profession or one of these, there's even arguments, and I can tell you, as you look at that as kind of how they define it, they pulled that from an old part of the tax code. So it'll be really interesting to see how you can interpret it. Because I don't know, if you go to the doctor, or anything else, do you know your doctor that you go see because of, them specifically, or did you just walk into, Duke Primary Care, right? Well, does that doctor, if they own or partial own that practice, how does that work, right? And so there's a lot of different interpretations that'll come out of how do you fall under this professional or, limitation. But the biggest thing there is if you're over those amounts, right? So if you're over 207 or 415, they're gone. You don't get the QBI. Kevin.
Is there a space of finding production?
It's a
Are those all that you just mentioned?
no, but I can get it to you. Yeah. Paul.
Isn't there a definition issue with, doesn't it say the primary asset is?
Right, primary asset or, right, reputation, trade, is that. So, yeah.
The definition of asset traditionally doesn't include provision of skill.
Yeah, so we'll see, right? Again, they rush this through and you can tell, right? But, if it works for you, you're excited. You're jumping up and down. If it doesn't and you're over this, you're like, man, how can I game this now, right? How can I make sure I'm not in one of these if I'm going to be over those exclusions, right? So again, if you're over 207 or 415, right, and you're in one of these, you've lost your exclusion, right? Yep.
Is it just the wages paid, or what about the profit distribution or dividend?
Say that again. So
So the distribution coming from the S corp is just a distribution of dividend to
Mhm.
owners. Is that qualified, or is it just the wages paid?
So what you're talking about as far as qualified business income, you're actually not talking about wages. You're talking about just the income, right, that would flow through to the owner
So any income that flows through the owner?
from that
outside
business.
of the dividend?
Yep. And let me kind of give some examples of this, and I'll talk about the other, kind of quick caps as well. The other two limitations, if you're not under that professional service, right, the other two limitations are essentially W-2 wages. And so your QBI deduction, right, we talked about that 20% times your qualified business income, is limited to 50% of W-2 wages paid, right? Only, remember, this only applies if you're over 157 in taxable income or 315 if you're married, right? If you're under those amounts, these limits don't apply. But if you go over 157 or 315, you got to worry about the profession, and you also got to worry about W-2 wages, right? So what if you're a consulting company, right, that doesn't pay any wages, right? You deal with independent contractors, whatever else, and you're over that amount, then your QBI deduction potentially would be lost. W-2 wages, 50% is one limitation, again, if you're over. The other, and this is where I really think real estate investors, others want out, is the capital test. So say you don't qualify under the W-2 wages, right? The other is called the capital test. And what the capital test says is your QBI deduction may be limited to the sum of 25% of the W-2 wages paid. All right, I'm a real estate investor. I want to go out and buy some property, right? And it's going to kick back rent. Am I going to have any employees? Probably not, right? So I'm not going to pay any W-2 wages. So that might be zero. But then it says the sum of that plus 2.5% of your unadjusted basis immediately after acquisition of all qualified property. What does that mean? It means your purchase price, right? So say I bought that property, for $1 million, then it's 2.5% times $1 million. So what they just said is, if you want to go out and buy a lot of capital, real estate, other things, even if you don't have employees, we'll give you that benefit. Wages test and capital test, right? Those are the two aspects. So let's look at a couple examples. Married couple, taxable income of $200,000. H has a sole proprietorship accounting firm. W is an employee and receives only W-2 wages. H's QBI is 150. So he has $150,000 of qualified business income times 20%. He gets a $30,000 deduction potential, right? Since he's below that $315,000 threshold for personal or professional service companies, right, because he's an accountant, the W-2 limit doesn't apply and he gets a full $30,000 deduction. Taxable income drops from $200 to $170 at a rate of 24% compared to 28% under the old law. Sorry about that. Big savings, right? So they just won based on that structure and everything else to carry forward because they are in that sweet spot on taxable income, even though they were a profession, and carried that forward. Next example, you get a married taxpayer with income exceeding $600,000 and has a 15% interest in a real estate partnership. All right? So married taxpayer, income exceeding $600,000, they have a 15% interest in a real estate partnership. So follow me on this, because this applies to REITs and other things as well. They bought, that real estate partnership brought in investment property, commercial property for $10 million. No employees, no wages. It just kicks off some cash, right? Partnership earns $500,000 of qualified business income times 15%, which is that person's stake in it. Taxpayers' allocated share is $75,000. W-2 limitation, right? We got to apply that because they're over our limits, right? They're over our limits of 315. So W-2 limitation, 50% times wages, 0. So if it was just that test, they would get no QBI deduction, right? However, capital test, 2.5% of 1.5 million, that's basically their allocated, right? 15% of $10 million, which was the purchase price of the property, equals $37,500 limitation, right? 20% of the 75 QBI is $15,000. So what you do, you take that 37.5, that's your high number, right? That's your limit. They get to fully deduct $15K off of $75K. Not a bad deal for somebody that earns $600,000, right? Flip it back to the accountant, and they lost, right? But for real estate and capital-intensive businesses, right, they get the full amount. Any question of why you think they did this, right? Why harm, profession or service businesses otherwise, but, give some capital? They want you to spend money, right? They want you to invest in production. They want you to go out, buy real estate, develop real estate, right? Because that feeds so many jobs, so much capital, everything else. So the deduction applies to per LLC. As long as your individual side, you'll get it on every, LLC that you potentially own, right? But you go over that limit, you lost it on all of them, right? So if you're over the limits. So it's key to, again, manage it, but a huge potential for tax savings. Probably, again, the most significant to, I'd say, normal business owners, right? Small, mid-sized business owners that we've seen, right? A huge bump, but some that'll phase out if they don't plan right. Yep.
For that capital test, the capital that you invested in real estate, is that for that current year, or it doesn't matter?
Doesn't matter. They actually allow you to take it for 10 years, but if you bought it before, you can get it, right? So, yep.
How do you manage it? Because everything at the end of the day comes to the individual, right?
Everything comes through the individual, right? You got to manage your taxable income. That number on line 43 becomes hugely important, right? Now, if you are under those limits and you qualify for this, then again, if you're a sole proprietorship, right, everything's going to flow through or whatnot, you're still going to get to offset that, right, on your Schedule C or whatever schedule you're reporting. If you're a partnership, you're going to get a K-1, and that K-1 is going to show your allocated QBI deduction. Does that make sense? So it's going to deduct it before it flows to your 1040. I mean, that's what I believe. We'll see it when it actually happens on a form. Another question?
Yeah, so as an example, let's say you've got 10,000 in rental income and 4,000 in expenses, taxes, and
Sure.
repairs, whatever. Is the deduction 20% of 10K or?
6K. Yep. So it's your income, right? Your, yep. Yep. Other significant change, any questions on the QBI, right? And I want to try to move forward and kind of close things out. Again, that's where probably the biggest change to most of our clients that are businesses, professions, anything else, and again, huge amount of potential tax savings. If you take that with the drop in individual rates, right? But again, you're going to have to manage how you qualify for those, especially if you go over that 157 or 315. If you're under those numbers, don't worry about those W-2 or capital limitations I just told you about, right? They kind of consider you as you're safe, right? You go over those, they consider you as either upper middle class or you're that ultra wealthy, and so now you've got to worry about how to manage taxable income to do that. And there's a lot of neat strategies that you can do to manage taxable income, but you need to manage it throughout the year, not just, November, December, and say, I wonder what my taxable income looks like. Call up your CPA and find out you're 100,000 over. Good luck. I mean, there's ways you can do it. You can give a big charitable deduction, right? And then you'll qualify. But there's other things that you can do definitely to look at it and carry that forward. Other questions on QBI? Yeah. Hypothetically, right? Right. Sure. Sure. A lot of reasons to do that. One, you move it over there, you're not subject to the property tax cap anymore, right? So anything that's business taxation, right? Business taxes paid to North Carolina will be a business LLC deduction, right? As well as you can now get a QBI deduction for it, right? There's always been this thing that the IRS allows you, if it's 2 weeks or less that you rent like your personal property, you don't have to pay tax on that. Plus, if you rent it more than that, you can get QBI. I mean, rents are included fully in QBI, right? So combine that with what we're going to talk about next, which is, capital and depreciation. I mean, there's a lot of wins on that side. So, yes, largely consider entities. If you didn't have them, like you didn't have an LLC before, consider it, right? Because that's going to be an easy way to say, sorry, IRS, this is a business expense, right? If you're running everything through a sole proprietorship, no formal entity, going to be a little bit harder argument to make, right? Other material deductions from the business side, right? So just quickly, bonus depreciation. Simple on bonus depreciation, from that standpoint is this. You used to be able to accelerate, if you bought something, the IRS would allow you to get this year, the year of purchase, you could essentially deduct more of it, right? A larger percentage, kind of move it forward instead of, if it was a normal 10-year depreciation schedule, you can move it up and maybe deduct 50% of it this year. One of the big things and kind of changes was they said, okay, you now get 100% in 2018. So if you, actually it ended in 2017, like September forward. If you buy something, right, a truck, that you need, equipment for your business, computers, anything else, fully deductible. Take it as an expense, right? So they want you to go out there and buy, right? As business owners, go out and buy and spend. You can fully take that depreciation deduction this year in 2018, and then it phases down over the years. Yes, sir?
Okay, so you buy a truck.
Yep.
This year.
For your business.
Can you sell it in 3 years? Is any recapture?
Sure. Potential. Yep. Always potential for recapture depending on, what your basis is going to be and otherwise, right? But again, it's if you're going to go buy something, and you get that bump, depreciation to accelerate it, that's dollar for dollar savings, right? So it should give you more income in there. But again, remember, it's going to increase your taxable income potentially. So looking at that, but they definitely want you to do that. Bonus depreciation used to just be offered on new equipment. You had to buy new equipment. Now they've said as long as it's new to you. So you can go out and buy something used for your business, right? And you'll get that deduction. So bonus depreciation is a big thing. Going along with bonus depreciation is something called 179 depreciation, very similar, right? The only big change there is the annual limit on 179, which is an accelerated depreciation. It was raised from 1 million to 2.5, right? And a lot more for real estate, I won't get into it, but a lot more items can now be accelerated under 179, right? Like for real estate investors or whatnot, if you put an HVAC on a building, you used to not be able to use that as an accelerated, now you can, right? So there's different things that they've said, yep, go do it, and you can depreciate it, take it right off your taxes in 2018, right? We want you to go out and spend money. So, I mean, really what it is, right? Entertainment expenses, right? Big change here is that, again, not to hit on the sports and everything else, we already talked about the loss of that under the charitable, but on entertainment expenses, those are gone, which is a pretty significant change, which says if you were a member of a country club, you can't deduct it anymore, right? You took clients out and entertained them, right? You went out and did a big, weekend retreat, fun for employees, no longer deductible, right? Pretty significant change that they said you're not going to have fun, right, in a business anymore. But, we gave you this other stuff. We gave you 20%, whatever else, but we think that's too much. And that was probably the, country club hit, right? So entertainment expenses are gone. There was talk about doing away with meals in general. Like if you go out and you're sitting with a customer, client, referral, anything else, networking, you get to deduct 50% of that. But essentially, they left that as 50% deductible. So meals are entertainment expenses. Check on it. You may want to reclassify some of those as marketing expenses instead of entertainment expenses, but really look at those different things. There's a number of other changes. A lot of them, though, that you've heard about, like interest deduction is capped. Most of that is for large business, so I'm not going to go through it. You've got some in your handout as well. Yes, sir. Say that again? The interest expense? Yeah, but interest expense, that's what I won't hit on. It's only if you're doing a business over $25 million, right? So for most people, it won't apply. Yep. So question on who wins, right? Just to kind of sum up and kind of, try to wrap up on this. Who wins? C Corps, big businesses, definitely. You've already heard we're reinvesting, we're going to bring money over, everything else, they're happy, 35 to 21%. They also get this bonus in 179 depreciation, which is huge, right? So you should see, David, you should see a lot of it change in 2018, right? But they're going to take an immediate hit and then hopefully recover as they go forward based on a lower, tax rate plus more items that they can take as a deduction immediately. Pass-through businesses, your S Corps, LLCs, everything else, if you're under those taxable limits, that 157, 315, you're great, right? You're feeling good. Or you meet the W-2 or capital asset test, right? You're still feeling pretty good. 20% deduction off of that, that's huge, right? I mean, as much as the C Corps are clicking their heels and feeling pretty good, most business owners should feel pretty good about that 20% deduction. Landlords, real estate investors, talked about that. You're getting the 20% deduction for all rental. You get more items included in bonus depreciation of 179. So it's a great thing, especially if you're over the over those limits, but you have to qualify under the capital test. Construction, heavy in equipment investment, plus you got employees, you're feeling probably pretty good. Manufacturing, same thing, you're investing in a lot of equipment. Independent contractors. If you were an independent contractor or kind of a quasi-employee independent contractor, you just feel pretty good because you just got a 20% deduction, right? If you were paying all your own self-employment taxes, now you just got a 20% deduction to offset it. Again, still other pass-through entities are still going to get that bonus in 179 depreciation. Individual taxpayers. I will say that if you look at it, even though there's a lot of who wins and everything else, most people will win, right? Most people will win because it's lower tax rate, right? But there are definitely situations, we walk through some of them on the exemption loss and everything else, or where you fall in those tax brackets that you may not. But definitely look at that from an individual side. Estates, you got double the amount of estate and gift tax exclusion, right? So you got much more window to play with, a lot of fun that can be had there on what type of things you want to structure in this next window before it potentially expires. Who loses? Individuals, maybe, right? So depending on itemized deductions that you would take, maybe you were heavy in mortgage interest deduction, now you're going to lose a little bit more of that. Depending on your taxable income, the number of kids you have, right? You had 6 kids, you make over 400, you're in trouble. Sports fans, sorry. You lost those college tickets deductions, you lost entertainment expense, so you can't take clients now and spend a whole bunch of money on it. And guess what? The poor athletes, they actually fall under that profession, that personal service limitation. So, LeBron James just has to pay more taxes. Poor him, right? Above the line? Sure, right? Yeah. Well, again, you really want to control. I mean, some of the theories, some of the things we've looked at is you may want to consider C Corps now. Because with C Corps, if you leave them in, it doesn't come out to affect your personal taxable income. So a lot of the structures that we'll probably implement as we go forward is, hey, create a C Corp over here, at least to manage some of your income, right? If you're going to be under the limit, take it out, right? You may pay a little bit, but work the numbers. But if you're going to be over, leave it, right? Leave it till next year or reinvest in the platform or otherwise. Business owners with income above 315, 157. Again, you just have to watch it. You have to either fall and meet the limitations under the personal service or the W-2 or capital test. So what to do, right? It's 500 pages. I just told you, kind of repeatedly, we're still trying to figure everything out. Starting in, September, October, I think probably all the attorneys here and myself specifically is just kind of looking at this, start following things, trying to see what the House, the Senate was going to do. They came out with this 500 pages that had conflicting things. They tried to resolve it, bring it all together. But the Internal Revenue Code is 74,000 pages long, right? And so, the key is we're here to help, right? As much as possible that we can do that. Don't just look at one of these items and say, man, I'm good to go, right? More than ever, based on taxable income, and how you're going to qualify, it's going to be a managed tax planning to benefit yourself, right, at the end of the year. So your next steps, if I were you, is one, definitely with NC Planning, the attorneys here, whether it's on the estate side or the business side, schedule a quick review. Make sure if you didn't have an entity set up, you set up those entities. You look at how your independent contractor status may work. There may be items there. Discuss impacts with your CPA, right? You got a good CPA, sit down with them and go through that. The other aspect is, over the years we've kind of heard from clients of the element of basically, hey, it's just tough because my CPA is busy, right? Or they do this or otherwise. Can you help with strategic income tax planning? And as much as we could come up with solutions or strategies or ideas, it was always a barrier to implement. So, over the recent months, what we've kind of put together and kind of been building towards over the last few years is essentially the BTP Consulting Group, which is different than NC Planning. So for those of you that know NC Planning, specifically what this allows us to do is to go proactive income tax advice under a process where we actually pair together with CPAs, with attorneys that do tax rep, under a process to look specifically for business owners, but to look at tax opportunities, right? Opportunities for savings that you can implement. Not just, hey, here's an idea, see if it works, right? Because where we got bottlenecked usually was we needed those CPAs to kind of go through that. So this kind of takes it in a process approach to see if there's real savings. And under this new tax law, there's probably going to be real savings for individuals out there. So again, any of these options are good, but do make sure you just don't sit and wait till, even late summer to say, hey, I wonder how things are working. It is an actively managed platform now to make sure you can get some of these opportunities. I know we're past time. Any questions that generally, and again, Kyle and I and the other attorneys will stay up and happy to answer any individual questions. If anybody else has any quick questions, otherwise we'll stick around. Thank you so much for coming. Again, feel free to email us or any questions. Here's NC Planning's contact, BTP's contact. We'd be happy to answer questions or just discuss generally and go from there. Thank you, everybody.